Hi Nixon Nation, my name is Eric Martineau and this is my wife Diane. We are both loan officers with Nexa Mortgage, but we also have our licenses with the insurance team. Today I want to talk to you about private equity banking, probably one of the most powerful financial tools available to us today. The reason I'm here today is because last December, Mike Cordes in one of our town hall meetings said he and Matt were looking for a better solution to the 401k that the company currently had. So I sent Mike an email and I said, hey Mike, private equity banking is better than any 401k because one, it provides benefits a 401k can't, like guaranteed returns, tax-free growth, no age restrictions, and no market volatility. So we bounced a couple emails back and forth, and finally, when it became evident that private equity banking is done inside of the wrapper of a whole life insurance policy, Mike wrote me the following, and he said, the big problem I see here is whole life. I'm not a big fan of it at all. I'll look into it, but whole life is not a tool that I am a big fan of. Okay, so I sent him back another one and I said, you know what, Mike, I hate typical whole life insurance too, but with all due respect, this is not a typical whole life insurance policy. I then told him that I had attached a video that I had made about how to 3x your real estate holdings, 3x the profits on your real estate holdings using private equity banking. I told him these are real examples and real numbers, and would he please watch it? So he watched it. He wrote back about an hour later and said, okay, I'm very interested. So what you're doing here is you're creating the idea of a bank, right? And I said, yes, Mike, that's exactly it. That is why the New York Times calls private equity banking the secret of the affluent. Because what you do is you learn how to become your own bank for your own family and or business. And so that's what I'm here to talk to you about today is private equity banking and how it is done. So there's going to be 4 parts to this presentation. The first one is about cash value accumulation contracts and what those are. This is a term that the IRS uses to distinguish how a private equity bank is different than other banks. The next section is I'm going to explain why the New York Times actually called private equity banking the secret of the affluent and the benefits that you can obtain from them. And then in the third section, I'm going to give you some simple strategies on how you and or your clients can use private equity banking to improve their financial standing, or better yet, create and maintain generational wealth. And then finally, I'm going to give you some real live examples. These are people that I've worked with. I'm not going to show you their names, obviously, but I'm going to show you accumulation contracts that I have helped create and that are helping others. And they should give us a broad idea of how this all works. What is private equity banking? And I'm going to use a third party to basically explain it. Ed Slott is one of America's most renowned tax experts. And he did a presentation called Retire Safe and Secure. And in that presentation, he talks about how we as Americans can take our money from forever taxed buckets of money to never taxed buckets of money and protect them from taxes, market risk, and longevity risk. So what is private equity banking? According to the IRS code, these contracts are called cash value accumulation contracts. That's the term the IRS uses when dealing with private equity banking. Now, an accumulation contract has to be written by a legal reserve insurance company, all right? It can't just be a bank or anybody else. It has to come from a legal reserve insurance company. So before we go much further, let me define what Ed Slott was talking about between forever taxed buckets and never taxed buckets. In the forever taxed buckets, we have our income and our dividends, right? We make a salary, we pay taxes. That one's easy to understand. The other one is tax deferred. This is also a forever taxed bucket. And these are our 401ks and our IRAs. And then in the never taxed environment, you're only talking about 2 kinds of things: death benefits from insurance and loans from insurance companies. And so when Ed Slott says we need to move our money from the forever taxed environment over to the non-taxed environment, that's what he's talking about. Moving it from taxable buckets into non-taxable buckets. And I make emphasis on this because a lot of times when we're talking to a financial advisor, we'll be trying to compare 2 scenarios, both of them that say make 5% or make 10% or make 15%. The problem is if you've got it 5% in a leaky bucket and 5% in a non-leaky bucket, they're not the same value. What makes a cash value accumulation contract so powerful? One, we can transfer our money from forever taxed environments like our savings and our investment funds, and we can move them into never taxed buckets. In other words, accumulation contracts. Inside of a cash value accumulation account, your money will continue earning interest and dividends without taxation or market risk. And that's one of the reasons why an accumulation account is so powerful. But it's even better than that. Once you have your account established, you can borrow up to about 95% of the value in that account, or your private equity, right? But you use it only as security or collateral. You're not withdrawing it, right? So without reducing the balance or your earning power. Think about that. Now, I said that to a friend the other day, and he was like, wait a minute, Eric, that's just too difficult to understand. That's too opaque. And this guy wasn't stupid. The guy makes about 40 grand a month. He's got 2 businesses that bring him good money. So he's not dumb, but he didn't understand that concept. And so he asked me to make it easier. And so I thought about it a second, and I said, all right, look, there are 3 functions of money. There is the banking or warehousing or saving of money. That's one function. And then the next one is the investment side of money, where we use our money to get a better ROI, right? And then there's the spending side of money. Well, here's what gets people sometimes confused. Obviously, on the savings side, we want our money to increase when it's in a savings account. We also want it to be safe and secure, and we want it to be free from market risk. Whereas in the investment side, we have the same goal of increasing the value, although we probably want to have a larger increase in value or a larger return on our investment, right? And so to do that, we expose our money to market risk, more return, that kind of a thought process, right? Well, the other one, obviously spending, this is where we want to increase our lifestyle or maintain our lifestyle. And those are the 3 functions. And where we're going to be dealing with today is just that one right there. Banking and savings side of it, okay? We're not discussing the investment side. And the problem we run into is that sometimes, because of market volatility, our savings account will provide us with better returns than our investment accounts. And so we get confused, or at least the market seems to get confused at times when people talk about accumulation contracts, and they think that they're an investment. And I really don't look at them as an investment. And again, this is just my own definition, but for me, an investment is exposed to market risk, all right? And a savings account is not exposed to market risk, regardless of how much money I make in either one of those. So I said to my friend, let's think of a cash value accumulation account as a savings account on steroids. This is a place where you can continue to earn interest and dividends without taxation or market risk, while at the same time you can borrow funds from the legal reserve insurance company, right, without dipping into or withdrawing your private equity. Where else can you find that kind of tool? So in a word, we're talking about arbitrage. Now, Diane helped me do the editing of this PowerPoint presentation, and when I got to that word, she said, you just got through telling them that you wanted to make it simpler or easy, and now you're throwing out a word that a lot of people don't understand. So let me just read you the definition. Arbitrage is the simultaneous saving and borrowing of currency in 2 separate accounts to take advantage of different interest rates with the same asset. And what is that asset? That asset is your cash value accumulation account. And because it is a cash value accumulation contract, in that contract, it is going to stipulate what your interest rate will be for the duration of that contract. In mine, until I'm 120 years old, right? So you get a contract that tells you how much you will be paid anytime you put money into that contract, that accumulation contract. And it stipulates what the interest rate is. On one of my accounts, my interest rate is 4%, okay? But I have another account I can borrow from, and again, because it is a contract, I get a contractual rate, again, for the rest of my life until I'm 121 years old, that I will pay when I borrow. And in my case, that's 4.76. So if you do the simple math, you take out the two fours, I can borrow money at 0.76. I can borrow money at less than 1%. Where can you do that? That is what is arbitrage. And that's what makes this so powerful, right? So this is a pretty simple concept for a loan officer to grasp. So let me kind of walk through this. Let's say I've got $50,000 in my accumulation account, right? And I've got that contract, that's my collateral, and it's going to continue to go up. And I chose 5%. I know I just told you my numbers were 4. I'm going to use 5 and 5 in this example just to keep it generic. But in mine, it's I can, as I said, I get an interest rate of 4 and I can borrow at 4.76. But again, every legal reserve contract would be different depending on the company you're with. So if I wanted to borrow money in my example I'm going to use here, I'm going to say that I'm borrowing money at 5%, right? And let's say I wanted to buy a car, so I'm going to amortize this over 5 years. Okay, here's how this works. My accumulation account is out there and it is earning 5% on $50,000 over 5 years. That means that in the first year, my account will have grown to 52,000, then 55, then 57, then 60, and then 63, right? So I will have made over 5 years in interest $13,814. Simple to understand. Now, I wanted to buy a car, and let's say I went and borrowed $50,000 from the legal reserve insurance company. Remember, I don't take this out of my account. My cash accumulation account continues to grow at, in this example, 5%. With mine, it's 4, right? So I borrow that 50,000, and the first year I've paid down to 43, and the next year I paid down to 33, and the next year I paid down to 24,000. The next year after that, 13,000, and then finally the 5th year I pay it all off, right? So during that 5-year span of time, I will have paid the legal reserve insurance company $6,614. So if we take the $13,800 I made and the $6,600 I had to pay, I end up with $7,200 positive cash flow or arbitrage. And that's what makes this so powerful. Now I want to explain why the New York Times calls private equity banking the secret of the affluent. There are a number of reasons why private equity banking is so important to the affluent. First of all, it provides us with guarantees. Guarantees. You don't get that too many places out there with zero market risk. Also, our cash is liquid and there's no restrictions on when we can get to it. Think like a 401k. Also, it is tax-free growth. And you can borrow your money tax-free from these accounts also. And lastly, private equity banking accounts are protected from the volatility in the market as well as creditors, bankruptcy, etc. So who are some of these affluent? Well, obviously the Rockefellers, they've kept their dynasty going for over 100 years, right? The Rothschilds, they've used private equity banking. Also, the Morgans, 3 generations of the Morgan family have kept their generational wealth intact due to private equity banking. So have some of our presidents, Roosevelt and Kennedy, right? And then all of these companies here have used private equity banking to help them grow. So what is it that private equity banking does for us? Well, what it does is it protects us from some of the things that would destroy our generational wealth. First and foremost, debt service, right? Also, retirement instability is protected through private equity banking because we get guarantees, and so it doesn't really matter how the economy fluctuates, we have guarantees that protect us from an unstable economy. Also, as I stated earlier, these accounts grow tax-free, and so we don't have to worry about taxation in them ever again. And probably where a lot of Americans would use this is to protect against the volatility that they get in their 401ks or their IRAs. What does private equity banking give us? Well, it gives us first and foremost a good place to get out of debt. It also provides us with a place to grow and protect our money. Have a known versus an unknown future because of the contractual nature of these accounts. We get predictability and guarantees. We also have zero market risk, which for me brings peace of mind, especially at my age. And lastly, we're able to build tax-free generational wealth. But for most Americans, the place where they're going to first utilize a private equity banking account is to get out of debt. Let's think about that. What does America look like today? We've got student loans that are in the trillions, auto loans are in the trillions, credit cards are in the trillions, and now homes also nearing $10 trillion. So what's $1 trillion look like? Well, there's 100, there's 10,000. Did you know a million can fit in a suitcase? When you're talking about 100 million, now it fits on a pallet. A billion, that's what Jeff and Bill have, right? Now you're talking 10 pallets, but that is $1 trillion. 1,000 billion or a million. And again, the housing debt in America is right at $10 trillion. So a question that you might want to ask your clients is, if I could show you how to get out of all of your debt in 9 years or less, to include the mortgage, without spending any more than you're currently spending now, would you do it if you could? When I ask people that question, the resounding answer is yes. So let's talk about some of these one at a time. Debt service. Am I suggesting that using other people's money is wrong? I mean, I've already told you I'm a loan officer. Of course not. I understand the power of other people's money, right? In fact, 10, 15 years ago, Robert Kiyosaki and Stephen Covey started a financial coaching program, and I was one of their coaches. So I'm very familiar with what Robert Kiyosaki has to say about entrepreneurship. And obviously other people's money, or OPM, plays a part for most entrepreneurs. But the difference is, and this is something that I like about Robert Kiyosaki, is that he defined an asset as something that puts money in your pocket. And that's the rub. If you borrow money and it's not putting money in your pocket, in other words, there's no arbitrage, then guess what? It's a liability. But it's simple to turn that liability into an asset using private equity banking. So what the affluent have learned is how to use other people's money plus arbitrage. Here's some examples. Walt Disney, he could not get a loan for his theme park, so he used his private equity banking account to do it. Doris Christopher, right? The pampered chef. She borrowed money from her private equity banking account. What about J.C. Penney? Everybody knows that during the Depression, he kept his company alive. But how? He did it with his own private equity banking account. And probably the most famous of all of them, the gentleman that started McDonald's, Ray Kroc, right? They even talk about it in that movie that just came out about him a couple of years ago, how he used his private equity banking account to expand his franchise concept. Okay, so debt service is one of them. Another one is the retirement gamble. PBS Frontline did an article, did a documentary in 2013 called The Retirement Gamble. In there, they begin this presentation by saying, one simple fact, America is facing a retirement crisis. Then Martin Smith says, half of all Americans say they cannot afford to save for retirement. A newscaster breaks in and says, the average American has lost over $12,000 in their retirement account. That's probably the 401k that we were talking about earlier. Martin Smith comes back on and says 1/3 of all Americans say they have next to zero retirement in savings. Are you or any of your clients dealing with this? So a question that you could ask them, are you 100% sure you're ready for a great retirement? And if not, private equity banking probably has a place in their life. What about the pension gamble? 5 years later, Frontline did a follow-on to the retirement gamble, and they called it the pension gamble. In there, they state, Frontline investigates the role that state governments and Wall Street had in driving America's public pensions into a multi-trillion-dollar hole. There's that trillion-dollar word, right? Martin Smith says, we're doing a show about the pension problem. You know, the teachers, the firemen, the cops, the people that work hard all day long and are worried that they aren't going to have a pension. Probably the most widely used arena for private equity banking to protect our generational wealth comes from market volatility. I saw an article the other day in Investopedia, and it was titled, "We Cannot Control Everything." And then it said, although it is a must, due diligence cannot save you from everything. Think about that. Who could have predicted 9/11 or the 2008 housing bubble or COVID? And each time the market does one of these uncontrollable dips, people lose thousands and tens of thousands of dollars in their 401ks and in their market products. And so uncertainty in the markets is one of the places where private equity banking can help us the most. So one of the questions that I like to ask is, how much of your financial security depends upon people or companies or economic systems that you can neither predict nor control? Now, am I saying that you shouldn't have anything out there in a risky environment? No. What I'm asking is, what percentage of your financial security is in that type of an environment? And obviously, if you're 25 or 35 or 45 or 55 or 65, that is going to change. But it's a question that we all should ask ourselves, right? And then the follow-on question to that is, how much of your financial security comes with guarantees? This is a cash accumulation contract, and that contract gives you guarantees. That's what brings peace of mind when you start getting up in my age bracket. The next one, the 401k problem. We've touched on it just a little bit. I'm not going to go super in depth on this, but John Wasik is one of the writers for Forbes. And he wrote an article a little bit ago called "Why 401ks Have Failed." And he quotes Professor Teresa Ghilarducci as saying that the 401k was an experiment and it has failed. And you say, so why is he quoting her? Who cares? Guess what? She helped create the 401k. She knows it was an experiment, and she also knows it's failed. She's written a book out there that's pretty good. It's called When I'm 64. I'd suggest you read it. But if you really want to understand why the 401k is not a good idea, go read Pirates of Manhattan. That's an even better book. So in my mind, the reason a 401k doesn't work is, one, it's uncontrollable, it's unpredictable, and it has age restrictions. So a question for you or your clients: are you happy with your 401k? Remember, this is the very question that Mike asked me, or asked all of us, that started this entire dialogue. He wasn't happy with the 401k he was offering to his employees, and that's what began this. So really the question I have in my mind is, why live with uncertainty when certainty is possible? So let's discuss now the solution. Okay, so we've talked about accumulation contracts, and we've also talked about why the New York Times calls private equity banking the secret of the affluent. Now let's give you some simple strategies on how you, whether you're affluent or not, can implement the power of a private equity bank in your life. The first step for most of us in implementing a private equity bank in our lives will be to just get out of debt. Here at the insurance team, we have the software and the training necessary to build you a cash value accumulation contract. Now, I would guess that only 1 in 1,000 insurance agents have even heard of a cash value accumulation contract. But we here at the insurance team know what it is, and we can help build those for you. So what you or your clients would end up with when you come with us is a customized turnkey debt elimination system that is based on proprietary software and comes with written guarantees. So why begin with debt elimination? Well, the problem with debt is that it eats up about 34% of all of our income. So for every $1,000 that the average American earns, $400 of that, or 40%, goes to taxes. About $230, or 23%, goes to our lifestyle, our fun, and our toys. 34% of every $1,000, so $340 of every $1,000 that we earn, goes toward debt service, principal and interest, which leaves us then only 3% left for saving and or investing. And by the way, it doesn't matter whether you're a high-paid surgeon or a school teacher. It's the same percentages for every $1,000 we bring through the home. So whether you bring in $5,000 by yourself or $20,000 as a household, how we spend our money is right what is shown there. So why debt elimination first? Leverage and arbitrage. There's just much more area there in that 34% than there is anywhere else that we can get a hold of. That's the average. And then with the power of a private equity banking program, we can also use arbitrage to get out of debt. So that's why we focus first on debt service. Let me give you an example of that. Return on investment. That 3% that you're shoving away into either a savings account or you've got going into a 401k as an investment or whatever, right? You've got a financial advisor. That 3%, if you were capable of getting a 10% return, which would be a pretty good return, probably before taxes and fees, but if you were earning 10% out there in the market, that's a pretty good return. And if you got that on the 3% that is typically saved by us, you just made $3 for every 1,000, right? Versus debt elimination. If you get rid of just 1% of your debt, you just put $3.40 back in your pocket. Well, which of those is the easier one to do? Now, a friend of mine said the other day, well, my advisor's getting me 40%. And I thought, oh, really? 40%. Okay, if you could get 20%, which is half of what he claims he's getting with his advisor, that would be $6 on the portion that you're saving or investing, right? Of that $30. Let's put that 20% into perspective. In Tony Robbins' book, Money Matters, he talks about Ray Dalio, who happens to be the most famous hedge fund manager on the planet today. Ray Dalio has a hedge fund with about $161 billion in it. And this is a hedge fund that's used by the 1% of the 1% of the 1%. And he has averaged, as Tony Robbins says, a mind-boggling 21%. Again, that's before fees and taxes, right? I saw another article out there a little bit ago that was published by CNBC Make It. The title to this article says, Warren Buffett warns against carrying a credit card balance. He said a friend of Buffett's recently came into some money and asked him for some advice. And the first thing he asked her was, well, do you have any credit card debt? And she said, yes, she did. And she was paying 18%. Warren Buffett replied to her, if I owed 18% on anything, that would be the very first thing I would do is pay off that 18%, right? He said, it's going to be way better than any investment idea that I could give you. He then continued, by paying off the balance, she would save more money on interest than any return she would get investing that money either in stocks or real estate or elsewhere, Buffett told her, right? He then said, and I thought this was interesting, I don't know how to make 18%. Again, I'm just trying to put that 20% because a friend of mine said that his advisor's getting him 40% into perspective. So if Ray Dalio and Warren Buffett struggle to get 20%, your local guy, maybe not. Anyhow, here's the point. If you could get even 10% of your debt service eliminated, that puts $34 back in your pocket instead of if you were investing and getting that 20% that we were just talking about, that would be $6. That's nearly a 6x return getting rid of your debt. That's what Warren Buffett was trying to say. That's the easy place. And besides, once you've eliminated that debt, you can always go and throw that money into an investment. So what happens if you wipe out 50% of your total debt? Now you've got an extra $170 in your pocket. So this is why we focus on it. Now let's bring it back to, say, the average American. In 2020, the average American household brought in $87,864. So 34% of that would be $29,873. Nearly $30,000, right? Think about that. What could you do with an extra $30,000 of liquid cash without getting a raise, right? Could you put it into savings? Could you put it into investing? Could you put it into your lifestyle? Could you divide it between all of them? Yes, 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 and yes. That $30,000 is like getting a raise because without getting a raise, you're getting the same amount of money. So the question to ask yourself or any of your clients is, how would $30,000 of annual liquidity help you or the average American family. You see, as a loan officer, I look at debt elimination as a priority. Now, obviously, we've all run into those people that have good credit, but just have too much debt. They're perfect clients for us also. But when you help somebody get out of debt, you've turned what was a transactional sale, a mortgage, into a transformational process in their lives. And so, like I just said, if you're a loan officer and you help one of your clients in less than 6 to 9 years put an extra $30,000 of cash flow into their pockets, what do you think they're going to do with it? Investment property? Bigger house? Exactly. So that's step one, eliminating debt. Step two is to become your own bank. I know, sounds crazy, huh? But remember, this was the concept that the light bulb went off in Mike's head and he said, wait a minute, so you're creating the idea of a bank? Well, it goes further than just the idea, because you will have an actual cash value accumulation contract that allows you to stuff money into it and then use that accumulation to be your own bank. So that kind of begs the question, how do banks make money? I know, we all think we know this, and it's simple stuff, right? But a depositor comes into the bank, and they put their money in the bank, and the bank gives them 1%. All right, that's a lie. Banks only give us like 0.35%. But be that as it may, I'm just going to use 1% as a safe place, right? So a depositor comes in, puts in some money, and the bank pays them 1%. Later on that afternoon, somebody comes in and says, hey, I want to buy a car. And the bank takes that depositor's money, and they give it to the guy that wants to buy the car, and they charge him 6%, right? Which begs the question, what was the gross profit for the bank? They pay the depositor 1%, they charge the borrower 6%. How much money is the bank making? I know a lot of you are going to say 5%, but if you did, you'd be wrong. You see, if I can make a product for $1 and I sell it for $1 plus 5 cents, $1.05, I've made 5%. But if I make a product for $1 and I sell it for $6, $5 more, I've just made 500%. That's what the bank is making. Now, let's put that into perspective. The average margin, profit margin, for the auto industry is between 13 and 21 cents. In other words, for every dollar that it costs an auto manufacturer to build a car, they hope to get 20 cents in return, right? The bank just made 500. Okay, so how does all of this work, being your own banker? Remember I told you, with my cash value accumulation contract, I'm guaranteed 4% on anything I put in my account, and I can borrow guaranteed at 4.76. So the net effect to me in borrowing, I can get cash at 0.76. Now, let's say I wanted to buy a car. And if I were to go to my bank or my credit union, they would charge me, say, again, that same 6%. So if I want to be an honest broker with myself, what I would do is figure out what $50,000 at 6% would be over 5 years, and I would make those payments to myself. If I did that, what percent did I just make on my own money? 690%. So how does one become an honest banker with themselves? I know, an oxymoron. But I went to Bankrate, to amortization calculator, and I put in the 50,000. I put in over 5 years, and I said the interest rate is 6%. And it gave me a payment, $966.64. Now, if I were making structured payments, obviously we understand that. If I were making structured payments to the bank, I would be making payments on that car for 5 years of $966.64. And that would be at the 6% rate, right? And so what I would want to do is, although I borrow the money from the legal reserve insurance company, right, and I'm borrowing at 0.76%, I'm going to make payments back to my own account as though I was paying 6%. And that's why I'm going to make payments in a structured fashion at $966.64 a month. Right? Just as though I was paying it to my credit union. The beauty about it is an unstructured loan. So if I fell on hard times 2 years from now and couldn't make that payment, I don't have to, because payments back to a legal reserve insurance company are unstructured. You don't have to make them if you don't want to. But I want to be an honest broker. It's kind of like, or an honest banker. It's kind of like, how to explain this? A friend of mine he owned a fast food chain. After high school, I went to see him. I was probably 5-6 years after we had gotten out of high school. He owned a fast food chain, and he invited me over to see him. And I went to his store. It was a Wiener Schnitzel. I went to his Wiener Schnitzel, and he invited me to lunch. And we were in his office inside the Wiener Schnitzel in the back room, and we walked out to the front, and he walked through the line, and he paid for some hot dogs for us, and we went and sat down. Now, he paid for them because he was my friend, but I thought that was kind of strange. I said, "Why did you pay for your own hot dogs at your own store, man? You own the place." And he said, "Because I have to be an honest store owner. I have to control inventory." And so if you're going to own your own private equity bank, you need to be an honest banker with yourself, right? So if the going rate for an auto loan is 6%, even though you can borrow at 0.76 like me, you'd still want to pay yourself back at, say, 6%. Now, obviously, there's some of you out there going, "Oh, wait a minute, I could do this for my kids." Yeah, what about your kids? Because maybe you don't need a car right now. But what about your children that are starting to buy cars? Okay, so instead of charging them 6%, you charge them 3%, but you're still making a killer percentage. In this case, on myself, if I pay myself back at 6%, I just made almost $8,000 over that 5-year period with my money. And that's how we become our own private bank. Now, here's the problem we've got. We've been taught that there's only 2 ways to purchase: cash purchases. Now, this is the Dave Ramsey way. Pay everything in cash, right? You save up your money little by little. When you get enough funds in there, in this case, the $50,000, you go buy your car. And as soon as you do that, your money goes back down to zero. Or the American way, we want things now. We go and borrow that $50,000 from a bank. We get the car and we pay that money back over time. In either scenario, we go back to zero. Let that sink in. Whether you pay cash or you finance, either way, once you've got your item and it's paid off, you're back at zero. Okay? What we weren't taught as individuals. Now, I got this in my MBA. I learned what opportunity cost was, but we have to understand there is an opportunity cost in everything we do. And in a business setting, I was taught to calculate the cost of capital or net present value of a company's capital before they went out and got involved in a project. I learned that in an MBA environment. But what I didn't think about is that I need to see my own family as a business. And so I should use a net present value calculation on everything I spend money on. Well, not everything, not bubble gum or whatever. But, on large ticket items, I should be using the same kinds of formulas I learned in my MBA on my family. And so it wasn't until I read this by Nelson Nash. He said, we have to understand that we finance everything we buy. You either pay interest to someone else, the financing side of that, right? Or we give up interest that we could have earned. Again, let that sink in. We finance everything, whether we pay somebody an interest rate or we lose getting that interest rate, unless we're using private equity banking to build our own bank account. Now, I know I went through this a minute ago, but again, if my accumulation account can make $13,800 and I have to borrow money and spend $6,600 to get it, and I can net $7,200, that arbitrage is what we're talking about here. Again, that's what changes what Robert Kiyosaki says is a liability to an asset, because now borrowing money just became an asset. Other people's money just became an asset. So here's how it looks like when we add that arbitrage of an accumulation contract into our purchasing environment. So in my example here, this woman puts away $10,000 a year for 5 years into her cash value accumulation contract. And then when she gets to the point that she's got the $50,000, she wants to go buy her car, she uses that money as leverage, as collateral to borrow from the legal reserve insurance company, and she takes out a loan for $50,000 from them. Right? She gets her car. Boom. and she pays it off over time. After 5 years, like we saw, $50,000 is what the car cost, $13,800 is what she made in interest on her accumulation account, $6,600 is what she paid the insurance company for the right to borrow their money, and at the end of 5 years, she trades in her car. She buys another one. It's cost more, inflation, all that. Don't beat me up about that in my example here, please. But let's say she just takes the value of the car and she buys another one. She gets another loan for $50,000, whatever that new car would be, which is be a bigger value because she still had some equity in her car, right? But she does that. And then she does it again 5 years later. And then she does it again 5 years later. Now she's got $78,000 in her account. And then finally in the 20th year, she's now bought 5 cars over 25 years. She's bought 5 new cars, and she now has $93,000 sitting in her account. Not zero. She never went back to zero. And that's only having saved that money the first time for 5 years. But remember, we just got through saying that the average American family, by getting out of debt in less than 9 years, is going to have an extra $30,000 in annual liquidity. So let's say that she takes 10 of that and puts it into this savings account. And she's still got 20 to put into investing or lifestyle, right? But she's got that 10. And so every single year, she puts another 10,000 in. Boom, 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 boom. Now, at the end of those 25 years, she still has 5 new cars, but instead of $93,000, she has $463,000 in her account. Not bad for just a savings account, right? All right, so far we've talked about cash value accumulation contracts and what makes them unique. We've also talked about why the New York Times calls private equity banking the secret of the affluent and how it protects the affluent. We've also discussed then 2 steps to using private equity banking: 1, getting out of debt, and 2, becoming your own banker. Now I want to give you some real-life examples of how private equity banking works in other people's lives. Now, these are real people that I've worked with. Obviously, I'm not going to share their names with you, but I'll be able to explain the story so you can see how these would fit into the lives of many of us. You'll recall that this all began because Mike told me he wasn't a real fan of whole life insurance. And I wrote back and said, I'm not either. Here's why. Most whole life insurance is based around death benefit. That's what it focuses on. In fact, it's called the base. And in most policies, that's 95% of the policy. So the majority share of what you've got is death benefit, right? And then a little bit of it is cash value, usually about 5%, so a very small portion of it. That's why I don't like whole life, and that's why most people aren't a fan of it. It also will come with restrictions. So from 5 to 15 years out, if you try to pull any of the cash value out of your policy, the restrictions and the penalties are so strong that it doesn't make any sense. And that's why most people do not like typical whole life. But we're not talking typical whole life here. We're talking about a private equity banking contract or a high cash value product. And with these, they are properly structured. When I say properly structured, 1 in 1,000 insurance agents even knows how to structure them. But a properly structured accumulation contract is about, let's say, 15 to 30% base, much less than the other. And then 70 to 85% of it, depending on what your needs are, is cash value. And so really you are creating the essence of a bank. It comes with guarantees of compounded interest. It grows, it's flexible, it's safe, right? It also provides dividends. I haven't talked about this yet because I've only talked about the guaranteed side. So your interest rate is guaranteed, the dividends are not. They typically run with good companies anywhere between 0.5 point and 1 point, but again, it depends on the company and your goals. Aside from dividends, you also have 0 early withdrawal penalties. So you can put your money in and 10 days later, borrow it back out and start using it, right? And then most importantly, they're tax-free. Again, back to what Ed Slott said, you're moving your money from an always taxed environment to a never taxed environment. And that's what makes these policies so special. So there are probably going to be about 4 different kinds of individuals that you will run into that need these policies. The first one is your W-2 employee, right? Back to that quadrant that Robert Kiyosaki spoke about, the top one being an employee. Then the next one are the self-employed, your doctors, your lawyers, your engineers. Now, a lot of these, it still says, you'll note that it says there, debt elimination. Why? Because a lot of these folks have a lot of debt from school and or equipment. I know my dentist is paying a ton of money on the equipment that he's got in his office. He's a young dentist. And so we've talked about these policies with him for that very reason. The next group are your business owners. And I love working with business owners. Why? Because you can smooth out cash flow. You can provide them key person insurance policies. When I say smooth out cash flow, by the way, what I'm talking about there is like, think seasonality. You know, somebody that clears snow isn't going to make much money in the summer, right? And somebody that sells solar panels isn't going to make a ton of money in the winter. So you've got seasonality or holidays when people make a lot more money. What these policies can do from a cash flow standpoint is help even out their cash flow. Even though they bring in a ton during the summer and then nothing in the winter, they can even that out so that they don't have to let go of employees during the winter. Because obviously, a solar company doesn't want to let go of all their electricians just because it's January, right? And then rehire them in March. That doesn't make sense. So it's a way of evening that out. And then the last one would be just the big, huge accumulation policies for the net worth, people of high net worth, the investors. Again, the 4 quadrants that Robert Kiyosaki talks about: employee, self-employed, business owner, and investors. So let's look at a typical debt elimination. This is just your typical American here. Notice that she has a bunch of credit cards, a timeshare, an auto, a truck, a lot of different things there, right? And there's the minimum payments that she's paying, and there's the actual payments. Well, the other thing that we want to look at is the overages that she is paying. I'm showing you how we structure these policies also, by the way. So you'll note that her actual payments come to $3,358 per month. But she overpays about $280 a month. And she and her husband are putting $170 into savings, which basically means we're going to be able to redirect inefficient funds to the tune of $450. Remember the question I asked at the beginning. If I could help you get out of debt in less than 9 years without spending any more money than you're currently spending, would you do it if you could? Right? And that's what we're talking about here, is finding inefficient dollars. And so that's one of the things that we do for you or your clients, is to find those inefficient dollars. And we're building a policy based on that dollar figure. Again, very different than a typical whole life insurance policy. Because a whole life insurance policy, they look at how much death benefit you can afford and then tell you this is what you need to pay. Here we say, where's your inefficient dollars? And we're going to build a policy based around that figure. And whatever the death benefit is, whatever the death benefit is, because we're not really concerned about the death benefit at all. What we're really concerned about is the ability to have leverage and arbitrage to get someone out of debt. Okay, so in this woman's case, again, she's married, but we're using her because she was a little younger and she's a little healthier. So $450 a month is what we're going to put into this policy. Now, this is an example of the software that we've got. And you'll note here it shows us who the lenders are. Now, I don't need account numbers to do this, by the way, ever, with anybody. So just don't think you ever need that. You know, I need to know, excuse me, I say what those accounts are, Synchrony, Capital One, etc., so that I can keep them straight, but I don't need account numbers. I need to know what those accounts are, right? And then what our software is going to do is show the year and the date when they're going to be able to pay that off. Also, it's showing us the interest rate that this woman was paying. 29.9, 25, 35%. These are some pretty hefty credit cards that she's got, right? Then it shows the total amount of principal and interest that she owes. Well, no, it shows the total amount of principal that she owes right now. It doesn't show the amount of interest. We're going to add that to it so she can see it. And then what the minimum monthly payment is. And then we also have here the payoff amount. Now, notice on that first one, the balance is $1,000, but the payoff is $814. That's because it's going to take us about 4 months to get to the point where we can pay that one off. And so by then, she's going to continue to make her minimum payments, and she'll only owe $814. And then the last one, and this is the column that's so important to us, is the roll-up amount. So once we pay off that first card, we've got an extra $70 there for her. But when we pay off that second debt, now we've got an extra $357. And after that, the next one, now we've got $422 going toward paying down her debts. And that's what makes this so powerful. But again, back to how we structure a policy, $450. So her total payment a month in debt service will not change. It's going to remain the same, $3,808. Her minimum payments plus the $450 that she was overpaying or not using wisely, and we're going to put that into this policy for a total debt service of $3,808, and that's never going to need to increase for her to get out of debt in 8.5 years. Think about that. We're going to take this family from 25 years of debt down to 8.5. All right, so let's walk through this step by step. In month one, remember, it's a policy for $450. Some of it's buying what's called cost of insurance, obviously. I mean, there's still a death benefit. This is still an insurance policy. So I'm going to say that there's about $400 available to her and the accumulation contract that she could borrow against in month one, not the whole $450. Even so, she's still going to be able to wipe out $311,000 worth of debt in just 8.5 years. So in month four, notice that she has $1,120 available to her in her accumulation contract that she could borrow from. And she's going to be earning 4% on that policy, same as my contract. So that's $45. Now, the payoff for that first Synchrony card is $814. You with me? And she's going to have to pay 0.476 for the use of that funds. And that's going to cost her $39 a year, right? So she's going to make 45, she's going to spend 39, and you're thinking, $6 whole, Eric? You made me watch this whole thing just to get $6 in savings? No, it grows a whole lot bigger than that. But that is the arbitrage on the very first card. But note, that balance used to be $1,000 and that interest rate was nearly 30%. And we just wiped that out. So what she didn't have to pay this year was $814 at 0.299, right? The nearly 30%. That saves her $243. So when you take the $243 that she saved by not having to pay it to Synchrony, and you subtract the $39 that she did have to pay the insurance company, she comes out with a total of $204. So she saved $204, but she also saved a ton of interest on that card, and that's the reason why. Okay, so now let's move it out to month 13. Let's say she's paid off 4 of these things, right? She now has a cash value in her account of $3,685. And once again, that is guaranteed at 4% interest. So she's going to make $147 that year on that portion of her cash value. Her payoff for the fourth card is $1,687. And she's going to have to pay 0.0476 on that, or $80 in interest. The difference there, $67. You with me? But now look at this roll up. Now we have $598 plus the $450 that we're putting in. That's $1,048 that she's using and freed up now every single month to go toward her debts. What if we move it out to year 2.5, right? 2.5 years into this now, she has $1,812 of liquidity that she's paying against her debts. You see how this is a snowball on steroids? She's going to be able to get out of debt quicker because she's used this method. And this is only in 2.5 years. She's freed up $1,800. Remember, her total debt service a month when she began this was $3,358. And she's just freed up in 2.5 years $1,800 of liquid cash per month that she can do with as she please. In this scenario, we're saying that she's putting it against her debts because that's her goal, but we've still freed that up for her. That's, more than half of what she was spending on debt. All right, so let's look at this in another way. If she had continued to do what the bank had her doing, she would not have been out of debt for 25 years. And when she did get out of debt, guess where she's at? The big goose egg, Zero. She's got no money. So she spent $553,000 in getting out of debt, in debt service over 25 years, right? Only to get her back to zero. Whereas using our method in 8.5 years, she paid off $311,000 worth of debt. And she's also freed up now at 8.5 years, $3,808 a month in liquid cash. That comes to $45,696 a year without getting a raise at her job. She has access to $45,000 more per year without changing jobs, only paying off debt in 8.5 years. And at the end of the 25-year period, she would have, if she continues to put that $3,800 into this savings account, and obviously she probably won't. She'll use some to increase lifestyle. She'll put some into an investment place. But if she continued to just put it into this savings environment, she'd end up with $913,000 in equity at the end of that 25-year period. Here's the interesting thing I haven't told you yet. This woman started at age 52. No spring chicken, right? Don't let her hear me say that. But she's as old as I am, right? She's 53 years old at the end of the first year. This is not somebody that's 25 or 35 years old. I'm not using an example of a perfect person, right? I'm talking about somebody who's already over 50 years old, starting at age 53, only putting in $450 a month or $5,400 a year in premium. Now, I want you to note over here where it talks about the annual liquidity. Notice how it goes up and down, right? For the first 9 years. That's because we're borrowing money, we're putting it in, we're taking it out. So the liquidity goes up and down. But then after that 8th year, 8.5 years, what ends up happening? She has zero debt. And as I just stated, she's got $3,800 more in cash available to her on a monthly basis. Now at age 65, again, she starts at age 53, now at age 65, only 13 years later, she's still at zero debt, and now she's got $228,000 in cash. Again, how far can we stretch this? She started at 53. If we go to age, well, and remember her normal debt, her home, she wasn't going to pay it off for 25 years, and now we're only stretching this out 18 years to when she's age 70. She's still completely out of debt, and she has $500,000 in cash. Starting at age 52, putting in $450 a month, we redirected inefficient dollars. Not bad for a savings account. All right, here's an engineer. This friend of mine had a Lowe's card, an auto, a city card, 2 houses, one's an investment property and one was a home, and a solar loan. $690,000 in debt. 29.7 years to get out of debt. And when you ask somebody like this, what's your total debt? They're going to know that it's the 690-ish, right? They can add up the mortgage. But what they don't add up is the extra interest they're paying. In this guy's case, an extra $526,000. So his real debt, total debt, if you just look at the numbers, 690. But if you look at the total debt, including the interest payments, if paid over 29.7 years, $1.2 million. We were able to help this engineer pay this whole thing off in 9.3 years, saving $332,000 in interest. And this engineer was about the same age as that other person. So liquidity at the end of 30 years, $2.2 million. Death benefit and the liquidity comes to $2.7 million. This is the kind of policy, this was done on $60,000 a year, so that's a $5,000 a month policy. And this gentleman, when I talked to him, our first thoughts were about getting a policy that was only about $700 or $800 a month. But again, he was an engineer, and he went home and he thought about it after we talked about it, and he came back and goes, I shouldn't have $700 a month. I should be putting in like $8,000 or $9,000 a month. Okay, hold on, cowboy. Let's ratchet that back. And we ended up doing about $5,000 a month. And by the way, this is flexible. So although he started it at $5,000, he's been able to ratchet it down or up depending on what his monthly needs were. moving forward. I can go into that in more depth with any of you individually, but just because he picked $60,000 a year doesn't mean he's obligated to it. He can ratchet that down a long way, but pretty good for a savings account on steroids. All right, now this one's a business owner example. This is a husband and wife. This happens to be the policy we wrote on the wife, and she's 57 when we wrote the policy, 58 at the end of the first year. And she and her husband were ready to retire. They had owned a retail store for about 30 years. A couple years back, they had the opportunity to purchase some real estate in a very good location for their business, right? And so they left the contract that they were with in a strip mall and they moved into their own property. But that incurred a pretty large chunk of money to get themselves this brand new building in this wonderful location. And so 5 years after they've got this new location, they decide that they're ready to retire, which incurs more expenses, right? They've got to hire a general manager and some assistant managers to take their places, right? And so I was over at their home and they were discussing all this, and they were concerned because they had enough money in the bank to pay off the mortgage, but if they did that, they were, getting rid of their cash flow. Yet at the same time, they didn't like where their money was sitting because it was sitting in a volatile market-based account, and they were worried that something would happen to the market and then they'd lose that, and then they couldn't pay off the mortgage. So you see the conundrum they were in? And I said, well, you guys can get the best of two worlds. You could start an accumulation contract and put, say, $165,000 into it the first year, and then 13 months later, right, because it's a 2-year thing, so the second, at the anniversary of the first year, so in month 13, they could put another $125,000 into it, and then as soon as that money clears, they can borrow it. So, a couple days later, they can borrow that back and pay off their mortgage. And that's what they did. And you know what happened? They were able to pay that off in October. And what happened 4 months later? COVID hit. And what happened to their business last year? It didn't go as well as had been planned. And because the business is still paying them rent for the building, that's because they own the building in a separate entity, so the business is still paying them rent for the right to use this building that they've now paid off. Well, they struggled during COVID. And luckily, they had their mortgage paid off, and even though they had a loan out from the legal reserve insurance company, they didn't have to make any payments because it was a non-structured payment. Now the company's back up on its feet. They're back to normal. Things are getting better. But that was what they were trying to prevent, and it's exactly what they were able to prevent. Now, you'll note on there too that it says payments of $40,000 between years 3 and 7. Those are what I call phantom payments, and they're paid out of the interest that is paid on the policy. So really they only made 2 payments, $165, $125, and then all those $40,000 payments come directly out of the account itself. But for IRS purposes, they have to run at least 7 years. Again, we can go into that in detail later. But this was what we call a 2-pay, 1 month 1, 1 month 13, and then after that they don't have to make any payments. They were then able to purchase or borrow what they needed, over $200,000, to pay off their mortgage, and that's what freed them up. So one of the reasons I love working with business owners with these policies is that they've got quick access to capital. So, as we know, opportunities come along as a business person and you want to buy something or, whatever, and you've got access to instant cash if you've got these. You don't have to run to the bank and hope that they'll give you the money so that you could invest in something that comes along. There's no credit checks, right? Again, you don't have to go to the bank and show them your P&Ls and beg them for money. You've got the cash in an account that's yours. All you have to do is say, I want it. The insurance company doesn't ask what you're using it for. Smooth out the cash flow. I already talked about that, the seasonality issues. Again, as I just explained with this couple, it's an unstructured payment back. So even though they borrowed the money to pay off their building to the mortgage company, and their business was still paying them rent for the building, and they were taking that rent money each month and paying it back to the insurance company, when things went hard during COVID, they didn't have to make those payments if they didn't want to. So again, it's an unstructured repayment. You can save businesses tens of thousands of dollars, and you can also protect the company against economic losses like I just explained with COVID. This is a $1 million key person contract. This was a number of siblings. So they bought key person contracts so that if one of the siblings passed away, their spouse could buy out their portion of the company. So anyhow, again, we build these things for the person as they need them. It's customized to you and your family. It's not a one size fits all. Here's another policy. This is an investor policy. These investors wanted to be able to get his cash out as quickly as possible to go use that cash again in a business environment. As the owner of this policy said to me, I make a whole lot more than 4% investing my money in other businesses and starting other businesses. Absolutely. But this gave them a place to put the money, take it out, borrow it, use it to build another business, pay it back, etc. And so that should give you some ideas on how these are done. Again, this is a two-pay, two $1 million payments, year 1 and year 2. And this is what they had available to them in year 2, $1.9 million available to them, and a $25 million death benefit. Just to recap, what private equity banking does for you is it gives you a better system for debt elimination. It's a good place to grow and protect your money. It gives you a known future instead of an unknown future, i.e. it's predictable with guarantees. You have no risk, which brings peace of mind. And then you're able to create generational wealth and maintain generational wealth. The Morgans and the Rockefellers are proof positive of this. That's why you don't hear about the Vanderbilts, right, as much as you do the Rockefellers and the Morgans. Why? Because they were able to preserve their wealth. Again, my name is Eric Martineau. My wife and I, would either one of us be able to help you or get a hold of anybody at the insurance team, and we can help you out to structure one of these policies. If you're interested, kind of like the real estate thing, where we've got real estate agents now working at Nexa. If you're interested in learning how you could do this for your clients yourself, get a hold of me and I'll help you out with that too. So private equity banking, it is very powerful and it's something that can help you and your clients. Look forward to helping you soon.